This flip-flopping of policy that we're seeing from President Trump, I'm just wondering, is it adding to the lack of clarity for the Fed?
Well, uncertainty is something that we are absolutely dealing with at the Fed as we're trying to navigate where inflation is going and where the labor market is going. And as I reach out to businesses all across my part of America that the Minneapolis Fed covers, uncertainty is top of mind for businesses large and small. They're all looking for some vision of where's the destination, where are these trade negotiations going to settle, so they can then move forward with their investment decisions. Until they get that kind of clarity, this uncertainty is overhanging the U.S. economy and potentially weighing on economic activity and obviously creating challenges for us because we're not sure where things are going to settle and therefore where we should go with monetary policy.
We've heard from the Fed again and again that it wants clarity before making a decision on a move. Is there a sense that perhaps you could get some clarity before September? Might that allow the Fed to make a move before September?
I mean, anything is possible. I don't want, between now and September, it's several months, obviously, worth of data that we're going to be looking at. The labor market has so far been remarkably resilient in the face of this uncertainty, though I hear from businesses that they are running scenarios, contingency planning, that if this uncertainty lasts for much longer, they are likely going to have to take some actions to reduce their workforce to position themselves to maintain some level of profitability. And so is that clarity going to be, is it going to be clear enough by September? I'm just not sure right now. Ultimately, we'll have to see what the data says, but we'll also have to see how the negotiations are going. Obviously, if major announcements are struck, meaningful announcements between the U.S. and our major trading partners over the next few months, that should provide a lot of the clarity that we're looking for. So right now, we just have to wait along with everybody else.
Neel, why the need for clarity? Why not just be data dependent for the next 3.5 years?
Well, we are going to be data dependent. I mean, certainly we have been data dependent, and that's one of our hallmarks of our policy process. One of the challenges we have right now is the data, of course, is lagging. And when we know that these tariffs have been put in place, we know that some American businesses knew tariffs were coming, and so they pre-ordered a lot of goods from abroad. So we're not yet seeing the full effect of the tariffs and the trade wars on the American consumer. You know, when I go out to stores in the U.S., store shelves are still full. So we're not seeing the impact of Target or Walmart not bringing in goods that they used to bring in because of tariffs. And so some of the data we know is going to be lagged. And then ultimately, these negotiations, how long are they going to take? And is there going to be a tit for tat? These are the dynamics that we're trying to navigate.
The thing is, Neel, we've had you say that you're confident the economy is on solid footing. I spoke to Jamie Dimon just last week. He says that we should actually prepare for stagflation. How do you square that?
Well, the fundamentals of the economy coming into this year were absolutely strong. We had inflation that was trending down, not quite back to our 2%, running at about a 2.5% level, and GDP growth that continued to exceed our own expectations for the last few years. So those fundamentals were very, very strong. And now there's been policy uncertainty that has been introduced to it. And that's what's causing this environment that we're trying to navigate. A stagflationary shock, if Jamie Dimon is correct, pushes up inflation, pushes down economic activity. But our monetary policy instruments either push up economic activity and inflation or push them both down at the same time. And that's a particularly challenging environment for policymakers to navigate. And that's why so many of my colleagues and I are saying we're really in a wait-and-see mode until we see which of these two effects, activity or inflation, which is the bigger effect that ultimately should drive our policy path.
As it stands now, Neel, how would you rate the chances of a stagflation? 30%? 40%?
Well, I think there's no question that the shock of tariffs are stagflationary. The question is going to be, ultimately, how high do they settle at? Right now, they're at a very high level, highest in 100 years. And how long a period both is this uncertain environment and how long are the tariffs going to last? If we have high tariffs for a month or two, but then they're negotiated much lower, the stagflationary imprint of that is going to be much, much lower. If we ultimately settle at a high rate for the foreseeable future, then the stagflationary impact will be much larger. And so is it stagflationary? Yes. But the question now is the magnitude of the stagflationary impulse, and we just don't know yet.
Let's talk about yields. It is a higher yield environment and much higher than before Liberation Day. We have 30-year yields in excess of 5%. What are you making of the rising yields for longer-dated bonds?
Well, there's a few different components that go into yields. One is the expected path of monetary policy. The second is inflation expectations. Our job is to keep that component down, to keep inflation expectations at 2%. And then there's just investor preferences, what people call the term premium. And if you look at the reason the U.S. has had a trade deficit is because it's just the flip side of a coin. The U.S. has been the premium destination for investment capital around the world. If the U.S. no longer seeks to have a trade deficit, then we would no longer have to be the premier destination for trade or for investment from around the world. And so I think what you're partially seeing is investors are reassessing where do they want to allocate capital to America, to Europe, to Asia. And I think as that rebalancing takes place, you will see yields around the world start to adjust to this new equilibrium. Of course, we're also seeing yields around the world all go up at the same time. So it's not simply a reassessing of the relative strength of these economies, but also questions about, I think, the debt dynamics and the growth dynamics of the global economy as a whole.
So wouldn't you say that the markets, in a sense, are voting on the tax bill in the U.S.?
Well, I think there's a lot going into it. Right now, the U.S. is facing a number of different major potential policy changes. One are tariffs and trade policy that we just talked about. Another one is a dramatic shift in immigration policy. The U.S. had very high immigration levels the last few years that have really been brought way down now this year, and that's going to affect how fast our economy grows in terms of less consumption, but also less production, less on the supply side of the economy. Then you've also got the fiscal policy changes, the tax bill that you just talked about, as well as regulatory changes. So I think markets are digesting all of these changes at the same time, and it's hard to attribute how much goes to one versus how much goes to another of those components.
Do you see the forces influencing the longer-term yields also pushing fund rates higher for longer?
Well, ultimately, we have to set the federal funds rate around our assessment of neutral. The neutral rate, the real neutral rate, is where savings and investment balance out. And if there's less investment capital flowing into the U.S., then you would expect, all else being equal, that the neutral rate will be higher. And that would mean that the Federal Reserve, as we set the policy rate, would have to be responding to that higher neutral rate. And so I think, depending how this shakes out over the long run, it could have an effect on the neutral rate, and then that will affect what the Federal Reserve, how the Federal Reserve sets policy to keep inflation expectations anchored at 2%.
When Moody's downgraded the U.S., it did say that there are expectations that perhaps if the tax bill goes through, the U.S. would end up using 30% of its revenues just to pay interest. And should that happen, we might see mortgage rates go as high as 7%. Is that a base case for you? How are you looking at that possibility?
Well, that's really not the job of the Fed. Our jobs, the assignment that we've been given from Congress is stable prices, 2% inflation, and maximum employment, and how the government funds itself, how much they want to tax, what they want to spend on, how they service the debt. That's the domain of the U.S. Treasury Department and of Congress. So we leave it to them to think about those issues. We know our jobs, and that's to get inflation back down to 2% and hopefully keep the labor market strong at the same time. And that's what we're focused on.
Neel, what are the companies in your district saying? Are they waiting and seeing? Are they delaying big investments?
That's what they're telling me, that they're waiting and seeing. If they can respond, if they knew where the tariffs would ultimately settle, they can then redesign their supply chain and optimize it around that new destination for tariffs and global global tariffs, not just U.S. and China, but global tariffs. But right now they don't know. And so they don't know whether they should build that new factory in Mexico, in the U.S., in Vietnam, in China or India, for example, just because they don't know where this is ultimately going to settle. And until they know, they really are just waiting and seeing and saying, let's just pause and hold here. And the question is, how long can they hold there? If all businesses are doing the same thing or consumers are doing the same thing, that obviously can have quite a depressing effect on the economic growth and the economic resilience of the U.S. economy.
Neel, we're seeing gyrations in asset classes, including cryptocurrencies. You are a crypto skeptic. The last we spoke, you said that you're going to keep an open mind. When U.S. assets tumbled last week, the U.S. dollar, equities, even treasuries, we saw Bitcoin rallying. What do you make of the movements? I mean, it's so tempting to see, or say rather, that perhaps Bitcoin was the adult in the room.
Well, I'm skeptical of that conclusion. Certainly when inflation took off and the Federal Reserve raised rates aggressively, Bitcoin got crushed. And first we were told that it was going to be a great payment device. It's basically useless for payments in an advanced economy. Then we were told it's a great inflation hedge. And when inflation took off and the Federal Reserve raised rates, Bitcoin got crushed. And so, the use case for Bitcoin and that the advocates make, it just keeps changing, one from the next to the next to the next. It's been 15 years. I'll keep an open mind, looking for some use case in an advanced economy where you're actually following the rule of law. I have yet to see it, other than as an instrument of speculation. If people want to speculate on it, they're more than welcome to.
Of course, stablecoins also making headlines. Let's take a listen to what Scott Besson had to say.
What we want to do is apply the highest U.S. regulatory and AML standards to digital assets, especially stablecoins. And I've seen estimates that just over the short term, stablecoins could create $2 trillion of demand for U.S. Treasuries and Treasury bills. To put that in context, the number is probably about $300 billion.
Of course, we heard from the crypto czar saying that stablecoin bill will be pushed through as well. Your take on it?
Again, this is the domain of Congress and the executive branch to decide how to regulate assets. I appreciated the secretary saying that you need to have appropriate regulations around the quote-unquote stable coins. I mean, ultimately, what is a stable coin? It is basically a bank. And so if it's basically a bank and it operates like a bank, then it ought to have bank-like regulations to make sure that it is operating in a safe and sound manner. And so I applaud the Secretary's comments there, and I look forward to seeing ultimately what Congress and the executive branch decide to do.
Neel, I appreciate that it is not the area that the Fed looks at. I'm just wondering still, though, whether there needs to be a clause, because there seems to be a conflict of interest. We know that the Trump family is involved in stable coins, in the crypto space. Is there a need for a clause preventing the president and his family from benefiting from such a bill?
That is things that are outside the domain of the Federal Reserve. That's about as far away as you could possibly go. That is purely up to congressional leaders and legal scholars to opine on, not for me.
Neel, as you take a look at the economy in the next 12, 24 months, what do you deem as the biggest risk?
Well, I think the biggest risk is overhang. How long the overhang of the uncertainty. Historically, trade negotiations and trade deals have taken a long time, months, if not years, to settle out. I certainly hope that the negotiations that are taking place can happen much more quickly than that, so that some clarity can be provided to businesses and consumers in the U.S. and around the world. That is a big overhang that I think we're all going to watch very, very carefully. But then that's just the tariff piece of this. Immigration, as I mentioned earlier, is another major policy change. The fiscal policy situation is another one. And then I'm also, of course, watching yields, global yields, the long yields all around the world, to try to understand what investors are saying about the future of the global economy and competitiveness, and obviously the balance between savings and investment. And so I think there are a lot of things to watch right now that's making this quite a tricky environment to navigate.